everyone. Good afternoon. Thanks for joining us. We'd like to start the presentation today with just a quick question for you all. So, how many of you have heard over the last few years that retail property is in decline, or it's suffering, or it's dead, or whatever?
That's it?
That's it?
You're lying.
I see half the hands went up, right? Well, my partner here today is Heath Binder, and he's been bucking that trend. Heath he manages investor relations at LBX Investments. He oversees investor relationships, high net worth and institutional capital, financial reporting, marketing efforts for LBX. And my name is Rich Dimeo. I'm with AppFolio, and we're hosting this session here today. And thank you very much for joining us. So what I'd like to do today is I want to get some more information from Heath as to what he's seeing in the market, how he's doing this with real estate. So I'd like to start, Heath, by just asking a basic question.
Sure.
Where does the name LBX come from?
So we have two managing partners, a guy named Robert Levy and a guy named Phil Block. So that's the L and the B. And then Rob's wife, she liked the sound of X, as a design feature, I guess. So we put that at the end. So LBX Investments, that's where it comes from.
Great, great. So the burning question, I guess, for me today, and I think a lot of the folks here, is why retail? I mean, there's
Sure.
so much negative news around it. Amazon's taking it over, and malls are closing, and all this stuff.
Yeah, Sears is going out of business, all that sort of stuff.
Yeah,
so
why would you guys? Yeah.
why do we kind of fly in the face of the retail apocalypse? So the simple answer is, we're value investors and we're contrarian, and you heard Spencer Levy talk about, he was pretty bullish on retail this morning at the keynote session, but when we look at the space, the baby has basically been thrown out with the bathwater, and this has been going on for years. So we really started digging into it in 2016. The team's very experienced. I mean, our two managing partners have been in the industry for, I don't know, Rob's been in the business for, I think, 30, 35 years, and Phil for around 20. So it's not like we're new to real estate, but we started looking into the real estate space, into the retail space, and what we realized was that the retail apocalypse was really overblown to an extent. There's definitely areas of retail that have their issues. So, for instance, enclosed malls have really struggled. But if you just think about a neighborhood or community shopping center, maybe a grocery anchored center, retail tends to sit on some of the best real estate in any submarket. And from our standpoint, our view was that if we could acquire really high quality assets at attractive entry points, that the demand would be there from the retailers, and that's really played out. I mean, if you look at a lot of the retailers that we work with, these are companies like Ross or Ulta. We've got some Target shadow anchored centers. If you just look at the numbers, strip away the emotion of all the headlines that you see, and actually look at how these companies been growing and opening stores and improving their profit margins, it's pretty compelling. So anyway, at a high level, that's why we went into retail when we did. We felt like the narrative was disconnected from reality.
Yeah, that's interesting. I have a few stats here.
Sure.
That I'll give back to you, and I think you originally gave them to me. Your portfolio is now more than 1.7 million square feet.
Yeah.
It's approaching 300 million in value.
More, yeah, we're at 345.
345.
Mm-hmm.
Yet, 5 years ago, looks like 5 years ago, 2016, your first deal was an $8 million deal with only just $2.4 million in equity.
That's right.
So tell me about that first deal, and what is the same or different about that deal compared to deals that you're doing today?
I mean, the deals we're doing today are a lot larger. The last deal we did was a $70 million deal. But the strategy fundamentally hasn't changed a whole ton. We just have, as you kind of go up in size, you're looking at deals that are, maybe they're going to be more expensive for a reason. They may be, in a prime metro or maybe, larger. That deal was a small deal. It was a deal that we bought outside of Nashville. We bought it at a pretty wide cap rate. Replaced a Goodwill with, I forget who it was at this point, but we replaced them with a better quality tenant. It ended up being a really good deal. But now everything's just a lot larger.
Shopping center asset management. What makes that so different than managing other types of asset classes and evaluating them? I mean, why is it different, and what is different?
I mean, there's a lot of differences. Shopping centers are pretty complex organisms, but in terms of how we're structured, we're vertically integrated. What we'll do when we go into a market that is a little bit too far away from where our operations are based, which is in the Southeast, then we'll work with a third-party leasing team. But in terms of asset management, we handle that out of Atlanta. But as far as leasing, you really need to have a local presence. I know a lot of folks here in multifamily. I mean, I think there's probably some maybe a comparison is for multi. It really helps to obviously have a local presence. We do have a local presence, but it's not as much from an asset management standpoint. It's more leasing, and the reason for that is because one of the ways that you drive value in shopping centers, a lot of times we'll buy from really large institutions, and they're really good at maintaining the assets, but they don't do a very good job with the active management of the assets. So we can drive a lot of value by, one of the strategies that we employ is we'll focus on, some of the what's called shop space. So the smaller spaces where you can get a much higher rent per square foot. And that's been, just a great strategy for us. It's driven a ton of value.
Great. And I also wanted to ask you about financing.
Sure.
So it seems like, in the current environment, it might be a little bit harder to get retail financed. Are you finding that? Or
No. So in 2020, yeah, retail was pretty hard to finance, and no deals really traded that year, but because of COVID. But we work with relationship lenders. We really stay away from structured financing. We don't like the CMBS market. So it's got to be balance sheet loans for us, unless there's a really special situation. So we've got very good relationships with several different banks and some credit unions and some life cos. And so we haven't had a problem finding financing for the deals. And what's interesting is look, a lot of sectors are more in favor, right? So if you're buying something at a low cap rate, maybe you're starting off a deal at negative leverage, and then you kind of work your way into a better stabilized yield. But for us, a lot of times we're buying deals and there's a lot of positive leverage. So we may buy something at a 9 cap or an 8 cap and finance it at 4%. So out of the gate, you're generating very attractive cash flow day one on a value-add asset that quite often is north of 90% occupied.
Yeah, so that makes me think, one of your challenges may be convincing an investor who really doesn't know much about retail to invest with you as opposed to some other market that's supposedly hot, according to the press and whatever.
I've often told people that if you can raise for shopping centers, you can pretty much raise for anything, because the climate has been, we have a pretty efficient capital raising machine at this point, but there's certainly a lot of selling objections that you have to overcome. I think, a few things. I'd say, first off, we keep our minimums very attainable for folks. So I'll let investors into a deal at a small number if they want to test us out, and hopefully they come back to us later on and they wish they had put more money into a deal. As far as, you think about your opportunity set, right? I mean, I think one of the big sales points about shopping centers, particularly the type of deals that we're buying open air shopping centers. Sometimes they're grocery anchored, a lot of times they're not grocery anchored. But I think one of the main ideas behind what we do is, A, we're pretty low leverage. We tend to be 60 to 65% LTV. And B, if you just look at the composition of an IRR, I mean, what is that? It's basically, you've got a current return and then you've got some sort of long-term growth rate. And in sectors where you're buying deals at a lower cap, a lot of that value is coming from the appreciation. And with us, we certainly see appreciation with our deals, but generally a higher percentage of the total return is coming from current cash flow, from operating cash flow. So, investors who like cash flow have had a very positive experience with us because of that.
Great. And then related to acquiring investors, who would you consider your competitors? Do you consider these other markets your competitors, or do you? When you
say competitors, you mean like other people
you're
doing?
Competing for people's investment. Right?
Yeah, sure.
Who would you consider or your competitors, and how would you differentiate yourself against them?
And look, there's a lot of money sloshing around right now, right? So there's room for everybody to play in the sandbox. You can make a nice full allocation across lots of different sectors. There are other retail companies doing what we do. I think, in terms of ways that we differentiate what we do, certainly the investor experience, which, that's my domain. So, I'm going to say this, but, I think our reporting is institutional quality. It's very, very detailed. Our view is that, if you put money with us, you should know exactly what our strategic plan is, but then, as the deal goes on, you should have, really good transparency into, how your investment is performing. I think as far as, the types as far as our approach as a company to deals, everybody says this, so it's not really a sales pitch, but the due diligence process that we put in place is extremely detailed. And we're happy to share it. So I have some investors who they just want to put money with us and they just want to get their check and they don't care. And then we have others who, I might have a $50,000 guy who I set up a deal room for because he wants to read all the documents and we're okay with that. So we really try to make it an experience where the investor feels they're getting whatever they need to get out of it in order to feel comfortable with how their money's been invested.
Well, thank you for that.
Sure.
I was reading a document on your website,
Mm-hmm.
Outlook, the outlook, and trends in the industry, and before the pandemic, there was a pretty significant view that retail was declining, and the common wisdom is that COVID accelerated that. How do you see things now? And do you think that, retail's on the rebound? Is that an exaggeration? What would you say?
I think it depends on, where you're focusing. So I don't know about enclosed malls. I don't know that they're on the rebound. There's still a lot of problems in that particular area. So I don't think you would see us buying an enclosed mall in a tertiary market. And I think if you look at how some of the retailers, and a lot of them are public companies, but if you look at how they've performed over the last several years, they continue to perform well through COVID. There was never really a blip, But, what I would say is, there's this term, the great accelerator, and what COVID and all things related did is it kind of weeded out a lot of the weaker players in the space. And it also forced a lot of retailers to become what's called more COVID resilient. And we've all seen this in our day-to-day. If you see maybe little innovations like the curbside pickup that wasn't there a few years ago, right? That's a good example. But so retail's a space where you really have to evolve or you're gonna die. And so the retailers that have been able to evolve through the mess that was 2020 and then part of 21, they've really emerged stronger. And the ones that if you look at who closed their stores down, it was a list of dinosaurs that groups like companies like Pier 1 and I'm just thinking of some of the other weaker ones that they were kind of on their last legs for years. So this was the knockout punch, and now they're gone. So that's okay. I mean, that happens in business. If you don't, I mean, it's like any business. If you don't evolve with the times, then you're gonna fall by the wayside.
We were talking before too about what types of retail companies are successful, right? And I think you had something to say about retail, or I'm sorry, web-based only retail.
Oh yeah, online versus offline.
And could you expand on that just a bit?
Yeah, sure. So with the retail apocalypse, right? One of the big fears has been Amazon, and everything shifting to e-commerce. And in reality, right? And I'm not an emotional person when I deal with this stuff. I just kind of look at the numbers. But in reality, the costs tied to running an online-only business are very expensive, and it's very hard for online-only businesses to be profitable. So this is counterintuitive, and it's counter to the narrative. But what you've seen is you've seen a lot of online-only companies that have been opening up stores in brick-and-mortar locations. And this gets into a much broader discussion around this concept of what's called harmonized retail. But effectively, if you're a company like a Best Buy or a Target, or there's a whole bunch of them. Best Buy is a great example. Best Buy doesn't care if you buy from them online or in store, on your phone, on your laptop. They don't care, right? They care that you buy from them. And so their objective as a company is to create an experience for you that kind of integrates all of these different, for lack of a better word, channels, right? But if you look at the strongest retailers, they need to have a brick and mortar presence because there are certain types of transactions that make a lot more sense in a brick and mortar setting than to do it online, right? And a good example might be, go away from Best Buy for a second, maybe look at an apparel company where you think about the cost tied to. I mean, if you've ever ordered clothes online and then you get them and they don't fit, and then you send back the return. Think about how shipping costs have really risen, right? I mean, if your retailer, having a brick and mortar location can really help cut down on the cost tied to that. That's a good example of what I mean.
That's a great example, because I remember I was doing some purchasing of those types of things online, clothing.
Yeah.
And they tend to continue to send you the same thing over and over again. And,
these companies aren't profitable, right? And brick and mortar really matters. And if you just think about, we all just went through this pandemic, right? And maybe it's still going, maybe it's not, but things feel a little better now than they did 3 months ago. And but when we got to, when we had these peaks and valleys, right? There were points when people were, less afraid to come out of their house, certainly in certain markets. And you saw the numbers. People like to be out. They're social creatures. They like to go and shop. And so this idea that brick and mortar is going to go away just isn't. It's not really based on anything other than people see Amazon's relentless growth and think that think we're all going to be, I don't know, getting carted around in self-driving cars over the next couple of years.
There are just some things that you need to see the merchandise in person.
Yeah.
And yep, I agree. I wanted to ask you, and you kind of alluded to it before, is transparency and providing information to your investors. And so I would be remiss, being from AppFolio, I'd be remiss if I didn't ask you about technology in your business, and what role does technology play in helping you manage your business?
I mean, it's important on a lot of levels. First off, we are remote. So we have operations in Atlanta and Charlotte, and our two managing partners are in Los Angeles and outside of New York City. And then we have third-party partners in cities around the country. So things that we all use, Zoom, Teams, things like that, are really important in terms of kind of helping keep everybody on the same page. Other tech innovations. This isn't probably applicable to every real estate sector, although it is for some. The rise of cell phone data, the location data. So you hear companies like Placer and Credit Intel. It's really important because you can see, basically with cell phone data, you can see whether or not a center is visited and to what extent, and then you can rank. So I can look at I can look at a Ross and I can see how it compares to 50 other Rosses in a state, which you can learn a lot from that sort of data, and that's all tech driven. And then as far as, we use AppFolio. It's been really great for us. As far as how that's helped our business, certainly helps with investor communications, and it helps me manage. We have hundreds of investors, so it helps me manage a pretty large network where maybe I didn't have those tools 3 years ago.
Right. That's something we see a lot of. Does your company, like when you evaluate new technologies and software or whatever the case may be, do you have a method or strategy that you go through to evaluate technologies?
Yeah, I don't want to veer off too much into, I'm not a tech guy, but we like companies that are agile, right? So that they make changes in response to your needs on a pretty quick basis. So that's been our experience with you guys.
Great. So I'd like to kind of change gears here just a little bit.
Sure.
We have about 10 minutes or so left.
Okay.
And I wanted to see if I could, I think there are quite a few people in the audience here, and I think some of them might have questions for you.
Sure.
Regarding the sector. And so if someone has a question, if they would put up their hand, we'll bring a microphone to you, and we'd be happy to answer your question.
Sure.
Just you talking about Amazon. Amazon's more like.
I can't hear you all that well.
Talking about Amazon, it's seemingly more of like a logistics company.
I still can't hear you.
Okay. Any better?
No, it's kind of. Maybe just shout it. Yeah. So you're getting into so the question is, I presume everybody heard it if I heard it, but the question, if I'm hearing it right, is, are companies trying to kind of steer traffic in store? Shop online and then. Yeah, so I'm not a retail operations expert. I give you a couple answers on it, though. So first off, there's something called BOPUS, which is buy online, pick up in store. And there's been a marked rise in that over the last few years. So I don't know if there's incentive. I don't know if I log on to bestbuy.com right now and buy something there and then go pick it up in store. If it's maybe I don't have to pay a delivery fee, but I don't know if there's like a bigger delivery or a bigger incentive than that. What I would say is getting into the whole idea of supply chains and obviously retail relies on that, and it's funny. Industrial's been so hot in part because consumers have been buying so much stuff that it's really it's really spurred on the warehouse business. But the larger retailers in particular have invested significant amounts of dollars in improving their fulfillment capabilities. So it used to be, years ago with like a Best Buy or Home Depot, if you wanted to get something, it would take several days a lot of the time for certain items, and now they've shrunk that, just generally speaking, because they've invested so heavily in being quick to get you what you want. I mean, the whole point of retail is, get the customer what they want when they want it, right? The most effective retailers, that's what they do. And they don't care if you're, if they're using your phone or computer or in store to do it necessarily. They want to just, they want to, make you happy so you keep buying more. Yeah.
What's a typical number of years for a full cycle, and what kind of returns do you see if you take out the ones that do super well and the ones that do
Sure.
medium?
Yeah. So, and I think that's the title, right? How we got double-digit cash flow last year. So I should probably speak about that. So generally speaking, so far we've been a deal-by-deal shop. Your general estimated holding period is anywhere from, call it, 3 to 7 years. We did one deal last year that is expected to go longer than that. From our standpoint, everything's been value add so far. And so if you buy a value add deal, generally value add in retail looks a little different than it might look in, say, multifamily, because you're not buying something that's distressed, right? You're actually buying a really good piece of real estate that maybe has been undermanaged. So, we may buy something that's, 90, 95% occupied, but the plan is to improve it over time. So, let's say you buy something at, an 8 cap and finance it at a 4, right? That's maybe an average deal. You're generating, really attractive cash flow out of the gate. So, what I always tell people is our average targeted cash flow is in the high single digits. Day one, we typically distribute, after 1 quarter of operations, and then continue on a quarterly basis. Target IRRs are generally sort of in this mid to high teens range. We've been, I think, outperforming on a lot of our deals, but that's sort of like a general kind of framework, and what I'd say with just thinking about, how these deals typically look, right? There's a few ways that we'll drive value. So one area is, again, we're buying from large groups typically, and they don't get into the weeds as much. So we'll generate alpha through active management. We'll drive shop space leasing, which really does move the needle. It's, leasing that 2,000 square foot space to a nail salon at much higher rent than you're going to charge the grocer that's right next to it. There are a lot of times pads out on the street, so maybe like a McDonald's or a Taco Bell. You'll carve those off and you'll sell those into the 1031 market because there's a lot of money chasing triple net 1031 type deals. So we might buy a center at an 8 cap and then sell an out parcel at a 5 cap or lower. So when you do that, you return some cash to investors, which is always welcomed, and then you're also reducing your basis, paying down some debt, de-risking your asset. It's a really, really nice strategy. It's not on every deal that we do, but it's on a lot of them. And then we'll make targeted capital improvements that can really move the needle in terms of making a center more attractive to prospective tenants. And what this all starts with is we look to buy the first or second best center in a solid submarket because it's all site selection. If you buy if you think about how retail works, a lot of times again it's in the middle of town. We go shopping. We don't go to the outskirts. We go to the center of town. So if we can buy something that's at a really good spot, and we can execute on some of those value drivers, then there have been a couple deals in our portfolio already that are ahead of schedule where we've refinanced them. And when you can do those, that's great. You're returning a bunch of capital to people, and now it doesn't really impact your distributions a ton, and now you're distributing at kind of a similar level on much lower capital base, which makes the returns look really good, right, from a percentage standpoint. But it's effectively kind of going back to the general idea here. retail has been, really oversold over the last several years, and so we can get in and buy, good real estate at attractive price points, put moderate leverage on and generate cash flow out of the gate with some upside potential. We tell people a lot of the time we're doing these value-add deals, but, it feels a lot like we're taking core plus risk. Answer your question?
I think we have time for maybe one more.
What is your best strategy for filling vacancies in retail? And can you give us an example of a deal that you lost money on?
I can't give you an example of a deal we've lost money on because we haven't. I can give you, if you want to talk separately, I can give you detail. There's a couple deals that we have where they're going to end up great, but the plan's evolved as we've gone on. But in terms of strategies to lease up space, simple answer I give you is buy good real estate. If you buy a good piece of real estate, then good times and bad times, you will have demand for that real estate, right? And one of the benefits to retail compared to some other sectors is there's not a whole lot of new supply, right? It's not like people are building new product, right? It's expensive to build, as we all know. Construction costs are high. And so what that means is if you're going to build new retail, you're going to need to charge really high rents. And that's not, you can't make the math work a lot of the time unless you're, I don't know, downtown Denver in like the fanciest location, which is not, what we're buying. So if you buy good real estate, the retailer's going to want to be there. Good tenancy helps a lot too. So we bought some Target shadow anchored centers. Like if you own a center and you have a Target that's doing $50 million a year in sales, right? Retailers are going to want to be next to that. So, there's a lot that, and it's a longer discussion, but there's a lot that goes into evaluating, the rent roll at a center and, making sure that, we're buying a piece of property where retailers are going to want to be. You got time for one more? You. '16. So we started in 2016. It was in a former partnership. So we started LBX in 2018. In that partnership, we bought 11 deals, but we parted 2 years into it. So we bought them out of a couple, and they bought us out of the rest. So since 2018, nothing's gone full cycle yet. We've had a couple deals that have refinanced. So we've had significant return of investor equity, et cetera. But we've got some deals we bought in 2019 that are, we haven't gone full cycle yet, but they're performing really, really well. We'd love to do as many good deals as we can. It's maybe 4 to 6 a year. It's hard. It's competitive in retail just like in other sectors, but from our standpoint, we certainly finish second a lot more than we finish first, but on average, I'd say we do around 5 deals a year. Yeah, there's no fund strategy at this point. We're mulling it over, but it's all deal by deal. Yeah. Avoiding, no. It's interesting because we've been in the Sun Belt, right, and really in the Southeast for most of our deals. Last year we bought something in Chicago, and we just missed on a couple deals in Philly. And one of the trends that we've seen is there's been a lot more interest. Sun Belt's always been hot, no pun intended, but there's been a lot more interest, particularly from the public companies, in buying in markets like Atlanta and traditionally liquid markets like Nashville. So we've actually been looking, in addition to those markets, we've been looking in markets that are maybe a little bit oversold or underappreciated. So we looked at a deal in Omaha. We looked at a deal north of Detroit, so in Michigan. So from our standpoint, I don't want to say we'll look anywhere. We don't want to look in the middle of nowhere, but we look for good real estate and good markets with good fundamentals. All right, good.
Well, great. I'm told we're at time. In fact, I think we're a little bit over time. Thank you, Heath Binder, LBX Investments.
Thanks, Rich.
Great having you.